for showing up. So this is Startup Sessions. I see some familiar faces, some people that have been here before. The format of this is really informal. So I tend to sort of answer a question that I've picked up on social media over the last couple days. And luckily, as I was walking to my car this morning, I had a barrage of emails and some things on social. So if you don't follow me on social, I do. So at Mac Lackey and my site, maclackey.com, I try to interact with people there and answer questions. So the format will be, I'm going to just sort of answer one of those questions from last night, but then it is an open Q&A informal format. So any questions you guys have, and I like to think of sort of burning questions, things that maybe you're looking for answers or opinions on. I may not have answers, but I do have a lot of opinions, so I can at least give you opinions. So just 30 seconds. I've spent the last 22, 23 years now in the startup sort of space. I started my first company about 6 months out of college. So generally speaking, I have been through most of the startup cycle. I've had a number of exits, been punched in the face, not literally, but a lot in terms of being an entrepreneur. So I've made a lot of the mistakes that entrepreneurs make. So that sort of shapes my point of view. These days, I'm spending more and more time trying to do this, sort of work with entrepreneurs and help them, advise them, accelerate their businesses, because it's something I enjoy doing. And then, finally, it's cool to do this here in Charlotte because I'm a native Charlottean, and Charlotte for the first 21 of the last 22 years was really tough as an entrepreneur. I feel like it's shifting finally. There's some really good momentum here. There's some great resources starting to show up. So things are changing, but it's not Silicon Valley. It's not New York. And so there are goods and bads that we have to embrace as Charlotteans. So anyway, I'll start with a great question I received last night. Overnight, someone asked me, they have a product offering. It's a couple-year-old business. They have what they sort of think is product market fit, and they have delighted customers. And so their real question was, okay, we're at a great space, great spot, but we can't scale. And it's probably, if not the number one thing I hear, it's the second thing I hear is how do I scale? And the sort of the root question was, do I build a sales force? How do I build a sales force? Do I turn on a marketing machine? Do I outsource marketing? And so honestly, my general recommendation in almost every case is instead of starting with sales or marketing, think about distribution. And what I mean by distribution is typically, this is almost always true, whatever your product or service is, whatever you're trying to take to market, there is existing infrastructure out there. There are retail stores that carry products like yours. There are independent sales reps who walk into retail stores or to business buyers with products like yours. There is an existing national sales force. There is some distribution channel out there that already addresses your customer base or your desired customer base. They understand products and offerings like yours. And so rather than try to go through the initial hassle of hiring a sales force, training a sales force, dealing with the human management of that sales force, understanding marketing, typically there's a lot of leverage in existing distribution. So I spend a lot of time with entrepreneurs around this notion of distribution. And in almost every case, if you spend the time, you can find someone that has that leverage. And so in the case of this company, sort of in the nutrition space, and there are literally thousands of people everywhere from multi-level marketing to existing retail stores to existing online channels that sell nutritional products like theirs. And so that was kind of my immediate thought is they need to go out to existing distribution, sell into that channel, and once they get traction, then they can make the assessment, is there enough margin in this for me to build my sales force? Do I need to do something differentiated? So anyway, that long answer, I would say, when you think about scaling a business, distribution should be on that sort of list of 4 or 5 critical success factors that you spend a lot of time thinking deeply about before you go on to sort of hiring people and dealing with all that. So that was a long answer to a question no one in this room asked, but hopefully it has some application to some of the things you guys are doing. So let me answer burning questions that you guys have. Tell me kind of what's on your mind, what you're struggling with, what I can help with, and we'll start there. Yeah. So it's a great question. So the question as a one-person kind of marketing or a consultant, you're a domain expert, you're a you're sort of in the guru industry to some degree. And I was just telling someone actually before we started that there's sort of this ladder that you have to go up that is, in the early days, you're trying to get paid for what you offer. And honestly, anybody that will pay you for your thoughts, your ideas, your service offering is a good thing. But once you create some momentum around that, the next sort of level is you want to be paid for the value, not your time, right? So that is divorce yourself from, getting paid for hours in the day, because that does not scale, right? So if you have great ideas, great tactics, but someone is thinking every time I want the tactic, I have to sit down with you individually, then you are capped by 24 hours in a day and some reasonable amount of money you can charge for that hour. So I think a lot about taking those ideas and turning them into sort of information products, right? So it's webinars, it's PDFs, it's things that are behind a paywall where you might spend an hour with someone, but then your playbook, and this is a lot of what I do, your playbook is basically worksheets, tools, things that people can buy from you where they don't have to sit down with you. And then you can start to think about, how do I get that product out? And that is really an exercise on, who's your target customer, who really values your time, how do you reach them, how are they buying products now, and then you can get into distribution. Because there are blogs and sites where people are looking for information that you probably provide, but you have to kind of build into the point where someone's not only looking for that information, but from you. And once you establish that, it becomes much easier to divorce yourself from that sort of time issue. So does that make sense? So yeah, the question, if you couldn't hear it, was basically as you pursue sort of distribution opportunities, especially as an early entrepreneur, when you're not sure if the value of your product is highly sought after from this distributor, how do you sort of create the right value exchange, and how do you interact with them? So it's a great question, and I think the reality is you are the expert around your product, and you have to be able to articulate why your product, your offering is differentiated. If you go to someone with what is a commodity or a product that looks like everyone else's, then you're probably in a price game, which is a game you do not want to be in. They're going to choose your product because it's cheaper, and that will always be sort of downward pressure. So I would say, the first thing you do is kind of that whiteboard session with yourself to say, what is the value proposition that I offer this distributor? How can I help them with their business? One of the most valuable things we can do as entrepreneurs is try to get out of ourselves and look at the people we're sitting across the table from. What is it about my product that makes their job easier? What is it about my product that helps them sell more, sell higher margin, whatever it is? So the first is making sure that you're really clear on that sort of value proposition. The second is, again, I think it's just reality, is it needs to start with a low friction test, because you don't have a lot of leverage. They have 1,000 retail stores, and you are an idea in their minds, and they don't know what it's going to look like. And so rather than let them say, well, we have 1,000 stores, and we'll give you a penny per product or $1 per hour, or whatever some low value thing is, agree to do a 30-day test, agree to do a 90-day test. We don't need to nail down all the specifics. Let's talk about how money is exchanged if we're successful. And then after 90 days, let's sit down and sort of assess what the relationship looks like. In the early days of one of my companies, a company called Mac Lackey, which had a physical product, an outdoor industry product, we actually had to do consignment with the first few retailers that we worked with. And that was because we had an unproven product, we had an unproven brand. They had existing customers, existing brands. I mean, customers came in and wanted to buy the North Face or Patagonia, and Mac Lackey's was a non-branded, sort of a nobody. So we said, give us a chance, put us on the floor, give us 90 days. If the product doesn't sell, we'll take it back. And so once the product started flying off the shelves, then we had the leverage to go in and talk about pricing and how we distribute. Then we also had the case study to go to the next retail store and say, here's what happened in this store, it can happen in your store. So I think, again, long answer to short, simple question is, be clear on your value proposition, that will help them. So put yourself in their shoes as a distributor, number one. And number two, always recommend until you get leverage, testing. And so hopefully your product proves itself out. The leverage sort of equation shifts. So you can go back and say, I want 90% of everything that sells. And if not them, someone else. So the question around, if you're doing a 90-day test, how do you invest in the activation of that or the promotion around that? And of course, it's a great question. It's very specific to where you are as an entrepreneur, where the product is, meaning if you're a funded company, you can throw capital behind a marketing campaign and you can really push into it really hard. If you're a single entrepreneur that's trying to build a business, you probably have no budget and have no marketing assets. So a lot of that would come down to, if you're on that continuum, if you're a single entrepreneur trying to get started, it's just literally pure hustle. It is, you've got a 90-day test, everything you can do on social media, everything you can do with friends and family, encourage your friends and family. I always say, like, I don't ever want people to step over the moral, ethical line, but I can assure you that everyone I knew was walking into those retail stores saying, do you guys sell mountain khakis? Like, I mean, they need to create demand, right? So the retailer needs to hear, like, oh, people are asking for this product, not for that product. And so I think you use that period to say, this is our chance, this is our opportunity to really prove our product has value, so you lean into it very hard. If you do have budget or resources that can help you, then I think you need to create activation plans around it. You need to really be intentional about that test, how people buy, market to those channels so that it sort of creates this self-fulfilling prophecy of, people want to buy in that channel, they're buying from this distributor, and so that distributor wants to kind of replenish. So that's sort of the general way I would think about it. It's a good question. So the question is sort of in Charlotte or in these non-tier 1 markets outside of Silicon Valley, New York, Boston, et cetera, how do you go about finding the right investor? And if it's not the number 1 question, it's the number 2 question related to startups, scale and sort of funding. And I have become a pretty vocal advocate for if you can, first of all, congratulations for bootstrapping to 90%, because that's almost always my knee-jerk reaction now is bootstrap if you can. Don't take capital too early. And a lot of that is not because the capital's not there, it's because capital in a lot of cases can allow us as entrepreneurs to have sort of false signals, right? So it seems like we're onto something because someone gave us money. Well, maybe that's not truly the right signal. The right signal is, do you have a product or service that the market is buying? And that customer feedback and that sort of virtuous cycle is where great businesses are built. And so capital should be an accelerant to that process, not the creator of the process in most cases. So anyway, if you're at 90%, I would say, first question that you should be asking yourself is, what is the use of proceeds? What is the capital for? So you're at 90%. Are you trying to get it to 100%? And you need capital because you need engineering talent, you need marketing support, you need distribution, whatever the case may be, you may need a physical office. So if you have all that stuff listed out, which most people need to take the time to really think about, if someone gives you $100,000, what do you do with the money? Then before you take the $100,000, is there another way to do that thing, right? Can you get someone to give you the space? Can you get a talented engineer to moonlight? Is there another way to attack it? So I almost always say, still try to avoid raising capital if there's another way to get there. If there isn't, then it is concentric circles. Concentric circles is the tightest circle is friends and family. The most likely place that every entrepreneur is going to raise capital is truly in that first circle of friends and family. If your friends and family will not invest in you, and there are a lot of reasons they won't. They may not have the capital, so that's an easy one. But you're most likely to raise money from that first concentric circle, and it leads to the next one. So I always say, get your family to invest, get your mentors to invest, get your next door neighbors to invest, because that is a signal to investors that you have skin in the game. A lot of entrepreneurs hear investors say, how much money do you have in this business? And for most entrepreneurs it is, I have no money. So I can't put $1 million in my company because I don't have $1 million. So the best way to answer that question is, I don't have any money to put in it, but my uncle put $100,000 in it, and this is a lot of money to my uncle. My next door neighbor who sees me in the lawn every day put money in my business. I don't want to lose his money. So that's a good signal to investors. Then, kind of next concentric circle out is angels, and angel investors tend to exist in every city. We had a meeting last night with Venture South, which is a group I'm involved in. 250 angels in the Southeast invested over $20 million in the last couple years. So money is getting invested here. Those are very structured groups. It's not just Venture South. There's Charlotte Angel Fund. There's IMAF. There's a lot of them. It's just literally finding those groups, following their process, going through it. So although I know it's hard, I don't really believe that there's not money in Charlotte. I've raised a lot of money, and a lot of it's been raised in Charlotte. But it's just not easy. It's basically continuing to sort of use those concentric circles of friends and family, and then who else do they invest with, and go to these angel groups and present to them, and it just kind of continue to grind through the process. So that's number one, and then number two is look for affinities. And so this is a generalized answer. I don't know what your business is, but people tend to invest on emotion and affinity. And so my investor base in my last company, which was a soccer-based technology company, if you looked at them, there were generally 2 or 3 affinities that they had. One was they may have some affinity for me because they have a relationship with me, right? Someone that I know or I've made money for, and they therefore invest with me again. The second is they're huge believers in the soccer thesis, right? Soccer's growing in this country. Soccer's a big demographic. There's a lot of soccer moms. So that affinity created connection with investors that I would not have been able to get otherwise. And then the third is the affinity around the problem that we're solving. So we were solving something for soccer families. And so if you have a high net worth individual that works at, let's say, the bank here in Charlotte, and they have a child that plays soccer, and I could articulate the problem and our solution, instant affinity. So I really, I've had much more success focusing on raising money through those sort of tight concentric circles and aligning with those affinities than I ever have going to general groups of high net worth individuals and talking about my business. So, and I've raised, again, tens and tens of millions of dollars, and I've never received $1 of venture capital. So I have done all that with angels and high net worth individuals, which is harder in terms of time, but the results I think can be really good. So those would be my kind of high level recommendations anyway. It's a great point. One of my mentors said to me very early in my entrepreneurial sort of life, you should care a lot more about the who that gives you money than how much. And that has been absolutely true throughout 20 plus years of investors. Is $5,000 from the right investors is worth a lot more than hundreds of thousands from either the wrong investor or a neutral investor. Makes perfect sense. So the question, that's a unique one. I like it. So if you have I've never heard it called that, but it makes sense, two-sided sort of business model where you have an end product, a t-shirt, that you're selling to a consumer, you're distributing in some way, shape, or form, but this product is procured from a unique source. Maybe it's a scrap, maybe it's a different kind of factory. So my personal point of view is the hard part of that is creating consumer demand, right? So if you have consumer demand, solving for procurement and sourcing is a lot easier because you go to a factory and say, I have 1 million people that want this. You need to fulfill that demand. So if it were me, I would spend a lot more time and energy thinking about how do I create consumer demand in a noisy market. Apparel, which I've been in and out of a little bit, is great when it gets traction because the brand tends to get a life of its own and people seek out the brand and they care about the brand and the backstory. And it sounds like just from the brief description, you're going to have a great backstory. It's going to speak to people's sort of, green, social, eco, lots of check. It's going to feel good, but translating that into me buying a product from you is still you're yelling into the noise of every retailer, every marketing channel. So I would personally spend a lot of energy around how you tell that story, how you reach the consumer, and then turn that megaphone back to the factories. And again, Mountain Khakis, just as one of my personal examples, we actually thought a lot about the scraps because it was kind of we're paying a lot for fabric. This is unique custom fabric. And, I forget the percentage, but a fair amount of it was just sitting in a heap. And it's like, what do we do with that, right? And so in our case, we tried a bunch of stuff. We would stuff dog beds with it because we had a lot of consumers that, were big dog, fans. But we never came up with that real product, that we could turn the volume up on. So I love the concept. But yeah, I would focus a lot on the consumer side because that's the harder piece in my opinion. I love the challenge because I'm drawn to brands. I think deeply about brands, but it is, not to discourage anyone, it is hard. It's hard to create a consumer brand in this market today because there is so much noise, so much stuff coming at you. And so I would encourage you, even on that question, which is who is your target, the more tight and niche you can make your target, the more you can stand out. And so even if it feels like, gosh, I'm creating this incredibly tight niche that there are so many people in the world now that you can reach, especially online, that you'd be shocked at the number of women between the age of 35 and 45 that also love animals, also are eco-conscious, also have 2 kids, get really, really granular. It's still a big market, but your story can be very tailored to someone who identifies with that versus consumers, which is too big. So the question is the goods and bads around sort of accelerators, incubators, things like that. And then part 2, if there is a capital component, so if they invest as a part of your process, what implications that has for future investing. This is where I would say I'm highly opinionated, so I take it with a grain of salt. Accelerators to me are almost like business schools. I also don't have an MBA, so I'm opinionated about that. If you're going to get an MBA, in my opinion, and you're not getting it from one of the top 5 business schools, top 10, whatever, yeah, somewhere between 5 and 10. To me, the value of that goes down exponentially. It doesn't mean that you don't gain valuable knowledge, you do, but a Harvard MBA means something a lot different than pick the next, thousands of schools down. 100% feel the same way about accelerators, incubators, et cetera. If you are in a general accelerator or incubator, you probably get some advice, you get some mentoring, but I think you can get that on your own. I think you can show up to these things, and there are thousands of them. You can go online, download video after video, connect with expert after expert. So now, if you get picked for Techstars or 500 startups, the reason those are valuable is they have already created the infrastructure around mentoring. They've created infrastructure around capital. So the chances of you getting on a path to success are a lot higher in those because that's what they're designed for. So my huge caveat would be, unless you're in one of those, I would say I probably wouldn't value it highly. If you are in one of those, the good ones understand the capital process. And so they are actually a glide path to capital, not a deterrent. So if you're in 500 startups or Techstars and they give you a check, they've designed it so you can raise additional capital, that you can attract additional capital. It should not be a hurdle to additional capital. If you get it from Mac & Co. down the street that wants X% of your company and writes a onerous check that's got all these odd preferences to it, it will either get wiped out in the next round or it will become a deterrent to capital. So I would just say, sort of eyes open, I would pick my accelerators carefully. So the question is around sort of product development companies and groups that take ideas and intellectual property, productize them, take them to market. Some of these firms can go kind of cradle to grave, beginning to the end of the process. And I would say maybe similar to my last sort of response, which is there are product development organizations that are very good. There's some here in town that people are probably familiar with, that I think they're talented, they're reputable. If you need industrial design, you need marketing support, you need 3D printing, all those things. Most of us don't have access to that, and so they can be really, really valuable in that process. The good ones are reputable enough that they're clearly not going to take your idea and steal it. They couldn't, because they would be out of business so fast because they would get sued. And So I'm a big believer in leveraging that infrastructure. I think the only caveat to that is similar to raising capital. If you can do it yourself, there is always that addition. It's just a trade-off, right? There's always that additional. You're going to own more of the company. You're going to have more control. You're going to be able to pick your kind of third parties, where these firms generally either going to have it in-house or they're going to have their pre-built ecosystem. So their industrial designers, their designers, their marketing team, their back-end, activation, which is great for 80% of the market. So if I come in and say I want to, invent a new coffee mug, can they do that all day long? If I think I have something that is truly game-changing, world-changing, I personally would probably step back before I went too deep there to say, is there another way to get this product out there, because I may want to handpick the best of the best. Particularly with product design, that requires a set of skills and investment in machinery. My very first, before I started my first company, I had a sports-related product idea, and I had no idea how to take it to market, and we had to find an industrial designer that knew how to create molds for injection mold, stuff that I knew nothing about. And I would have spent way too much time trying to figure that out. So it was easy to hire an industrial designer that already had that expertise, that already knew the factories and, so prototyping and all those things. So I think those firms can add a lot of value. It's just picking them carefully like anything else. Well, I think, it's probably a little too specific for me to be really generic on, but I think that if you're working with a good firm, they understand the whole life cycle. They understand how to engage with third parties, whether it's you come to them with an idea or a best-in-class provider. One of the things that I think is really cool that's happened in the last couple years in particular is the idea of using the crowd to do some of that work for you. And so a lot of people, as you're seeing now, will create a crowdfunding campaign around I don't mean it in a negative way, but a half-baked product. They'll have something that's close enough to get on a video and test market demand. They'll use the money from the crowd to complete the product. And I'm a fan of that. It's kind of like rapid prototyping. I may not know all the answers, but I'm using the crowd to tell me, is there truly interest in this product? What are they looking for? What are they willing to pay for it? And again, there's a lot of these groups that will help you do that. And instead of paying out of pocket, let the market pay for that. So I love that concept personally. The question is, when's the right time to incorporate? Number one. Number two, is there sort of relevance or importance around the state in which you incorporate? Great question. I think, like a lot of things in the startup world, the process of creating a legal framework around your business has become so easy and efficient and relatively inexpensive that I recommend doing it really early. So again, I don't know if there's any attorneys in the room, and attorneys add a lot of value at the right moment, but LegalZoom is one of many online providers. So literally creating an LLC around the business is hundreds of dollars, not thousands or tens of thousands. So if you have an idea, if you have a product, if you're pursuing something, there's so many benefits, protection, tax benefits to having an LLC. And I mean, there are other structures, but my knee-jerk is having an LLC pretty early in the process to put your intellectual property there, put your contracts there, have an entity is such a kind of a no-brainer at this point that I recommend doing it early. I have LLCs that are not, they're not doing anything. I just have them because I know I will need to leverage them. So I would say early, LLC. The second question is kind of what state? And really I have one opinion on that, and it's simply the path of least resistance is incorporate in the state you're in unless you have an assumption that you're going to be doing a lot of transactions in deals, whether those are distribution deals, joint ventures, all those kind of things. Then the path of least resistance is a Delaware LLC, which is just as easy to form online. And the reason for that, for those of you who are contemplating this, is Delaware is kind of considered the standard set of law. So almost every attorney has their local state law and Delaware law is the two sort of sets of law they know. So Delaware becomes the universal language of contracts and deals and things like that. So I tend to do North Carolina or Delaware LLCs if I'm creating a startup that's like your business that's local, or it's a consulting business. Most of your business is going to be in North Carolina. North Carolina LLC is fine for that. If you're going to be doing a lot of business with others, Delaware LLC is kind of the other path of least resistance. The only other caveat I would throw into any of that is, if you know for whatever reason that you're going to raise venture capital, not angels, not friends and family, but true institutional capital, being a C Corp is almost a requirement from the venture group. Now you can always do that conversion later, but my last business, Kick, we actually were a C Corp because we planned on raising institutional capital, and so that was just going to skip a step for us. But other than that, personally, I see a lot of benefits to an LLC. They're simple, they're easy to use, and like I said, I tend to use LegalZoom just to form them. It's a pretty simple conversion. It's definitely not a reason. I mean, like I said, unless you're almost 100% sure you're going to raise institutional capital and you're pretty confident that you'll do that successfully, I don't really see a lot of reasons to incorporate. Just do an LLC. But if you know you're doing that, if you're going to create a chip fabricating business and you need tens of millions of dollars, like just start with a Inc. So. Yes, good question. So the question around kind of what does the capital structure look like, and this is the sort of Mac Lackey answer to that. I'm sure there are actually much more thoughtful resources online that will classify capital, but I think of kind of those tiers as friends and family, which literally to me means yes, they're angel investors. They should be accredited, meaning they meet the SEC's definitions around accredited. They have the wherewithal to write you a check. But they're not sophisticated investors in most cases. That doesn't mean your family and friends aren't smart. That just means that's not what they do professionally. Angel investors to me are accredited but truly sophisticated investors. They have a percentage of their net worth that they allocate to early stage companies. They do more than one a year, so they're kind of structured in the way they do it. Venture capital is the next tier up. That is a captive fund, and so myself and a friend may start a fund. We go out and raise money from third parties, whether that's institutions or families or whatever. We may have $100 million, and our job is deploying capital on their behalf. That sort of venture capital structure is what most people think of when they think about institutional capital for early stage companies. There are a couple tiers kind of above and around that are also, in my eyes, somewhat institutional. One of the most interesting and hard to tap and find is family offices. And so family offices are ultra high net worth, typically 50 million and above kind of families that have a lot of wealth, and they hire a team to allocate wealth for them. And so I've raised a reasonably large amount of money from a family that they can write a $20 million check out of their kind of checking account. That to me is institutional, even though it's a family and there's a name behind it. That's a big check, and they have institutional structure. They have a team of analysts. They have CPAs on staff. They're very institutional in the way they think and deploy capital. So that's one. And then the other is private equity to some degree. Private equity tends to be later stage. Don't invest in startups. Don't invest in what I even think of as high growth. They're kind of later stage growth. Larger check sizes, larger funds, but some private equity groups have the ability to invest some percentage of their capital in earlier stage companies, and that just means that their investors have given them some degree of flexibility. If they find something unique, they can do it. And so I never recommend people spend time on any of those tiers unless they have a pre-existing relationship or some reason to believe their business lines up incredibly well with that fund or those individuals, because that's not what they're set up to do. I've blogged about this a lot. I'm still amazed at the number of people that show up to venture capital firms and imagine that you're only raising $1 million, so venture capital firm has $100 million. I'm a great fit for them because they have to write a smaller check. you're definitely not a fit for them because they need to write bigger checks. It's just the way it works. So I've blogged about that. I would encourage you to go read not only my, but other people's blogs about how to make sure the amount of money you're looking for is very aligned with the investor type you're talking to. Because if you talk to a venture capitalist about a $500,000 check, you're wasting your time and theirs because they don't do it. Private equity, if it's below 10 million, they probably don't do it. In some cases, 100. So those are sort of the classifications I think of. Yeah, so it's a good question. So navigating, if you find a distribution partner or a strategic alliance kind of partner that you think is the right one for your business, how do you sort of navigate into that? And maybe sort of statement of the obvious, but I think the best way to do that is to get as precise as possible. Particularly with these large organizations, what division is the right buyer of that service that wants to partner with you? What individuals are the decision makers within that? So you almost need to get kind of to a bullseye of it's this person in this group and know who they are. And then it is, what is the very clear value proposition that makes them care? I mean, it's kind of that, like I've had a blog post that I refer to a lot about why should I meet you or care? And I always encourage people before I sit down with them to read that blog post, just because I don't want to be a jerk, but I want them to think about what we're talking about. And so I would say the same thing in business setting is, when you go to someone at UPS, let's say, and they're an executive VP of UPS Capital, they have a job that is very specific. They probably have a bonus and incentive plan that is how they need to allocate time and grow their line of business. If you don't fall into that perfectly, unless you have a game-changing idea, you're almost wasting their time. So rather than go through all that time and effort, it's find out who that individual is, do the research to figure out how they are incentivized, what they're trying to do, and make sure you are aligned to, you're a catalyst for that. Once you get that conversation, it is just good old-fashioned, how do you get 1 degree from them quickly? And I tell you, in this city, and just almost anywhere, I just feel like everyone is truly 1 or 2 degrees from anybody. And so, once you get really clear on who that person is and you go to LinkedIn and you find out how you're connected to them, you're probably within a week of being able to get an email into them or a phone call or some sort of warm introduction. So I guess my long-winded recommendation is get really precise about the who it is, and then just make sure you've taken the time to imagine how you help them. You know how they'll help you. That's the easy part. How do you help them? I agree with that. I react. The things for me that kind of move the needle for me, because I get hundreds of emails, unfortunately, and it's hard to process them. So it is, for me, I do react to cold emails if they hit a bullseye for me, something that I care about or I'm passionate about. And it doesn't take long to research me and figure out what those 2 or 3 things are. And so if someone calls and says, I want to pick your brain over a cup of coffee, it's like, yeah, I hear you. Why would I do that other than I like coffee? But if they say and fill in the blank with something I really care about, it's like, oh yeah, great, I got time tomorrow. So I think it's, even if it's cold, if you really, really drill something that's specific to that person, it can work quite well. I honestly, it's probably one of the things just like I've struggled with personally almost more than anything is I try hard to be open and available, and I want to help people. I mean, all those things are truly important to me. And so I struggle with the fact that I want to be nice. I don't want to be a jerk, but I also want people to understand. I mean, it's physically impossible for me to even get through the emails I got last night, much less what's going to happen today during this meeting. And so for people that are just like, oh, I want to chat with you, I want to pick your brain, like that is impossible. And so asking people to do and I'm not important. I mean, if you're sitting in a corporate buyer position and you have hundreds of people reporting to you, multiply that by some big number. So I think it's really smart for all of us, and I say this to myself, before I sit down with someone or before I even ask them to sit down with me, do your homework, understand what they care about, understand what you can do to help them. And if they're gracious enough to give you time, make sure you're really clear on, of course being appreciative, but like try to help them, even if it's a little thing, People may not be able to help me with business, but they can help me with life or my kids or something, so. I'm pretty dressed for my daughter. Yes, ma'am. So the question is sort of dealing with failure, and particularly, yeah, getting punched in the face, which I love that. I think that's one of those geographic things, right? So we live in a city, to some degree, a region, an area of the country where failure is viewed differently than it is in other parts of the country. I have a longtime friend and associate who has done incredibly well. He's now out on the West Coast. He's done well. And if you look at his background, what's interesting about that is it's hard to sort of piece together the success that led to the success. It's failure, 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 home run. And it's really hard to imagine how that happens. And so I think one of the things that we're uniquely trying to deal with in this kind of market is how we use failure as a catalyst versus my life is over. And so I tend to tell people, I've had a lot of at bats. So when I talk about 22, 23 years of startups, there are 3 or 4 or 5 that have been the primary focus of where I put time and energy. Some of them have been very successful, some have been moderately successful, and I've been punched in the face. I mean, I've had startups that didn't work. I've had the worst thing that ever has happened to me is an awful lawsuit with a former business partner that I didn't see coming. I mean, I feel like I've been punched in the face. So I think the answer to failure is a teacher. So individually, it's hard when you have truly thrown everything into a business and it has outright failed by the definition of like it's bankrupt or there's no buyers or whatever the case is. But in almost every case, your next step can be better based on that failure. So what did you learn? That's obviously important, but most importantly, how do you articulate that to people? And so I think what great entrepreneurs do better than most is when they go in and they're raising capital, they're trying to bring on business partners, they talk about not only what they're doing now, but what they learned, right? So I've had a number of people sit in front of me and say, my last business burned through $5 million in capital. It went bankrupt or whatever. But here's what we learned that I've applied, and it's the most valuable lesson I've ever learned. And I'm an open book. I mean, I got kicked out of college. I lost a soccer scholarship to a great school. That was a hard punch in the face. And so I had to, it's the best thing that ever happened to me, shaped me in a lot of ways. I had to be able to explain to people why that was a good thing versus the obvious, like, oh, I got kicked out of college, and therefore my life is over. It could have been. It definitely could have been. I chose to use that as here's what I learned, here's what I did wrong, here's the mistakes I made, here's how I've turned those around, here's why it's the best thing that ever happened to me. I actually thought about years ago applying to one of those top 10 MBA programs, and I started writing my essay, and that was literally the first line is, I was kicked out of college, period, in the essay, because I wanted to embrace the fact that perceived failure was literally the best thing that ever happened to me. So I think it's all about making sure you learn from it and then being able to confidently articulate lessons learned. That would be I have a lot of long-winded answers this morning. Sorry. Yeah, sorry. Yeah. Does that help?
Yeah, super helpful.
Okay, great.
I had a small.
Whoa, and hey.
This is a statement.
Okay.
So to your point, someone told me.
Yeah, people ask me a lot, like, what do you recommend book-wise? And that's such a tough one. I'm a voracious reader. I think it's kind of part of what you have to do. And I recommend to people try to diversify out what you read, because if you end up reading the same sort of genre and the same type of message, you miss out on things. But one of my favorite sort of things to do is read about people. I mean, so Phil Knight, obviously, I don't know the whole backstory.
A lot before he got to Knight.
Yeah, but he's one of those that has had a pretty amazing life, including the bads, which great entrepreneurs, great people that have been very successful should be pretty open. It's just very rare that you find someone that's just had a straight line to success. I mean, it's rare. Most people have had a punch or 6 in the face. So, all right, one more question. Burning question from someone else. Just kidding, I love it. One of my favorite questions, and something I care deeply about, I think deeply about. So the question is, how do you balance family and business. And the traditional views, again, stereotyping to some degree, is that is either a balance question or it is a trade-off question. And for most people it is, if you're going to be an entrepreneur and be very successful, and successful is a relative thing. So I always talk about scale businesses. To me, scale business is 8 figures, 8-figure revenue, 8-figure value. So if it's 10 million and up, in my mind, you're starting to talk about scale. Some people would say that's a gnat of a company. To me, that's a scale business. So most people think if you want to scale a business or going to have a scale business or run a scale business, you're probably working 7 days a week and sleeping on the floor in your office, and you probably are going to get divorced, and your kids are going to hate you and all those things. And that sadly does happen to people. I made a decision after I sold my second company. It was kind of an epiphany moment for me. I sold my company. A month later, my first daughter was born, and I just made an outright decision that I was not going to have that trade-off. And it was going to be, I'm going to not give up on my interest in scaling companies and building big businesses, and I'm going to miss nothing from my family. And I, knock on wood, my daughter's going to be 17 next week, and I've never missed a Donuts for Dads or coffee at school or carving the pumpkin. And the reason is I literally design businesses with that in mind. I have to design what I call life wealth. Like, I want time. I want time with my family. I want time with my kids. I want to travel. And so I don't think of it personally. I don't like the word balance. I like the word fusion. It's one of the things I think about, which is I kind of work 7 days a week and I spend time with my family 7 days a week. That's what works for me. I design around that. So when I travel, my kids may go with me. When I sit on the back porch on Sunday, I may be sitting there, but I'm working. So to me, fusion is one of the ways I've done it. But it is being very, very intentional. It's probably the number one thing I spend time with entrepreneurs where I'm kind of helping them build their business now, is taking the time to design your business so that you can have life wealth. And if you're not intentional about it, your business runs you. So I literally will design the calendar of a business that I've not even started yet. Like, here's how I'm going to work. I'm going to get up and do this, and I'm going to work these days of the week, and I'm going to take Fridays off, or whatever it is. And I literally, because what that translates into is my investors understand the way I work, my coworkers, my partners,